Government debt around Southeast Asia has risen in recent years. It has brought in many countries from Thailand to Malaysia, Vietnam, and even the Philippines to have a sudden spike in their overall national debt. This led to numerous worries throughout the society of each nation and brought scrutiny across the governmental boards. The Philippines has stood out amongst the rest when it comes to debt. According to the Department of Finance of the Philippines, the government debt is expected to be around 13.43 trillion Philippine pesos, or around 235 billion US dollars, which is a ratio of about 62% relative to the country's GDP. This figure has been amongst the most cited worries around society. It was called one of the worst in Southeast Asia. Yet what is little known around the region, or even around the entire continent itself, is that the Philippines actually stands out with a different form of debt, one that is also cited as a crucial component of an economy. The Philippines has one of the lowest when it comes to household debts. According to the Central Bank of the Philippines, the country has around 2 trillion Philippine pesos worth of household debt, which just boils to around 35 billion US dollars, and a ratio of household debt to GDP of 10%. For comparative purposes, the major Southeast Asian nations have a far higher figure than that of the Philippines. Indonesia has 17.2%, Vietnam has over 61%, Singapore at 69.7%, and both Malaysia and Thailand around 89%. This means that other major Southeast Asian nations have household debts that almost equal the entire economic output as calculated by their GDP, whereas the Philippines just holds 10% worth of debt compared to the annual GDP of its country. This can tell us that Filipinos, unlike their neighboring countries, are more than likely unwilling to take on debt. Or it can tell us that loans are not as easy as it is to get compared to other Southeast Asian nations. Well, we will discuss more why the Philippines' household debt is so low. For now, we will need to discuss what actually is household debt. Household debt is basically as the term suggests. It is the combined debt of all the people in one household. It includes mortgage debt, the money loaned to buy a house. It includes consumer debt, which could be in the form of credit card debt to student loans. With such a low debt on these factors, does that mean that the Philippines is not buying houses? Or are they just buying it outright with cash? Doesn't make sense for them to do so, since the Philippines is not a very wealthy nation. And even if it is, most of the countries with a higher household debt to GDP tend to come from more developed and more affluent countries. Well, one of the reasons why we found out why the Philippines has a far lower household debt has to do with the country's housing system and economy. Mortgage debt is the single largest cause of high household debt, and in the Philippines, the housing sector is wildly expensive. A report published by the Global Property Guide has found that in the entire Asian continent, the Philippines emerged as the fourth highest country when it comes to house price to income ratio, a figure that calculates how much the average housing costs in a country and compares it to the average income of an individual. Or in simpler terms, the Philippines is one of the least affordable places for its population to purchase a home. This ratio in the Philippines is higher than that of Thailand, Malaysia, Indonesia, and Singapore. This affordability could already tell us one of the big reasons why mortgage debt is so low. That is because the average Filipino can't afford a house. The second reason is due to the economy of the Philippines. The Philippines, unlike its neighboring country, is still at the beginning of its growth. Most nations with a higher household debt are nations associated with developed nations, but countries with lower household debt are known to be developing nations. This is due to the fact that developing countries' GDP increases far faster than the rate of borrowing compared to developed nations, whose nations' GDP growth tends to be less. It could also be because these developed nations tend to have a higher disposable income, where spending and consumption are way higher, and the need to continuously spend is favored by its governments, and even implemented through various fiscal and monetary means to support spending. It could then lead us to the question, is a high or even low household debt a dangerous indicator for an economy? Well, low household debt is indeed a safe indicator for the Philippines. The worries of having to service their interest repayments and the case for an asset collapse would not be entertained. This household debt therefore is not a problem for the Philippines, but that does not mean that the ratio would continuously be low forever. The household debt of the Philippines relative to its GDP has actually increased over the years. From 2016, when the household debt was around 7%, to over where we are today, at around 10%. Not significantly, but the trend is continuously going up. This is again likely due to the increase in borrowing rate, which is more than likely to weigh heavily on the Philippines' housing sector, where income is slowly catching up to real estate affordability. To explore further, if one day the Philippines does indeed become a nation with high household debt, will this be an indicator of danger? What are the likely outcomes of high household debt? Frankly, yes indeed, household debt is a big indicator. Several studies published by many economists and researchers throughout the decades-long history of the modern economy have shown that high household debt can trigger a recession. And once a recession hits a country with high household debt, this will inevitably have more consequences, as the higher the debt is. Debt repayment services would be foregone. This will collapse the entire housing market and send real estate prices spiraling down. Overall household consumption is reported by the International Monetary Finance to fall 4 times. And a further study has found that higher household debt is a factor that slows the entire economy's growth. Therefore, it was suggested by economists that lowering a country's household debt is key to improving economic growth. Although so far we've been so keen on suggesting that the Philippines has one of the lowest household debts in the world, they're also amongst the most stressed people when it comes to debt. According to a report published by an Amsterdam-based firm known as Forrester Consulting, they found that compared with the rest of the entire Asia-Pacific community, 70% of Filipinos who are in debt are struggling. The same report found that the entire average of Asia-Pacific consumers is just around 49%, which is 21% lower than the Philippines. This struggle in debt was attributed to difficulty in managing finances, which most importantly severs their ability to save. This cultural or educational attitude could also be one of the reasons why the Philippines has a low household debt, due to the fact that finance management is not as properly taught across the population. Fixing this type of issue, however, is not as easy as macro management by the government. When debt fear is embedded in one's culture, it tends to be unchanged despite thorough management by government actions, such as the case of Japan, which had a huge asset bubble that sparked the term the lost decade. This economic burden that Japan faced led their corporate and household debt to be warier against the use of loans. Despite years or even decades of work from the government and prominent economists, their ability to take up debt has disappeared. Corporate debt in Japan or the balance sheets of public companies have amongst the lowest debts in the entire world, and it is mostly attributed to their previous asset collapse, which led them to rely on their own savings and cash flow to produce their goods. Would the Philippines be the same way? Was the previous economic collapse that the country faced due to this? Or was it just because of the fact that financial literacy is not as good as it is around the world? Although what we think is probably one of the largest reasons why household debt still has not reached the likes of its neighbors, is due to the lack of financial instruments that are made available throughout the entire society. Financial technology, or fintech for short, is one of the emerging platforms that are slowly changing the Philippines. Take for example Gcash and Maya, 2 players that have in recent years re-innovated the entire financial ecosystem of the Philippines. Through their works, we've seen a huge increase in financial access to millions of Filipinos, which is due to their instruments being made easily available to the majority of Filipinos. Their e-wallets act as a type of bank, and the ability to use it by paying and sending money through a wide array of products and services. It will definitely be one of the country's game changers when it comes to debt leveraged available for Filipinos in the coming years. The huge gap will ultimately be filled, just like any other nation that went from developing to developed. But as always, these are just our opinions. Anyway, what do you think?